Yes, guys, so welcome back to the Diamant Capital YouTube channel. I think it's finally time we actually get into some strategies. Up until now, over the past few years, past 2 years of having this channel, I've mainly been talking about the knowledge and the ideas behind everything that we do. But it comes to a point where you realize what people are actually looking for is not the knowledge, because almost everyone knows how to implement smart money concepts. The problem is how to actually put it into a strategy and actually use it to our advantage. So what I've decided to do for this video is create a 4-hour strategy to meet the needs of you guys. There's many of you that might have full-time jobs. You know, you can't be on the charts the whole time, and you're looking for something which is a safer approach. Again, when you're not on the charts all the time and you have a full-time job, or let's just say, for example, you're a student and you don't really have that much time to be looking at the 5-minute chart, the 1-minute chart, this strategy is going to be perfect for you. So throughout this video, I'm going to be going through it step by step. I have a lot of case studies and quite a few examples that we can go through. So we're going to be going through everything slowly. But yeah, in general, at first, we're going to be going through the whole idea behind it. So let's just scroll up and just have a little look. Now, in terms of the steps, what we're mainly going to be looking for is this kind of area over here. Now, by the way, if you do want the PDF to this, and I can send it to you for completely free, it's going to be one of the links down below. You'll get the full 4-hour strategy PDF guide, and obviously you can use it to your advantage whenever. Now, in general, when it comes to the steps, what we would always have to do is look at the trend. So the first step is looking at the trend. Now, in general, when we are looking at the trend, we're going to be zooming out on the higher time frames. Now, again, like I've mentioned, this is going to be based on the 4-hour chart. Again, bringing it back to normal market structure, you know, we've talked about it many times, but it simply is just trying to look for the direction of the market. You know, we're going to be identifying highs and lows, for example, something like this. And then obviously the next few steps is where we're going to be implementing how we actually get into it. Now, in general, the best way to identify the general trend is by actually marking out the 4-hour highs and lows. Now, this generally is going to be quite simple. There are times, for example, where you've got a lot of wicky sort of candlesticks. So for example, it might look something like this, and then let's just say the next one as well is also going to be something like this as well. You know, you might find it quite difficult to actually pick out these highs and lows, but in general, the way I would identify a high and a low is going to be something like this. So if we just mark that up like that, so these two are up candles, this one is a down candle. It doesn't matter if it engulfs it or, you know, does anything with it. It simply just has to print, the middle one has to print as the highest candle. In general, this is the easiest way that you can mark out any high or low. So in general, when we are looking through the charts, we're going to be marking out highs and lows like this. So what I would do personally is, let's just get the circle tool, if we can find it here. So what I would usually do is just mark it out with a little circle tool, square tool, whatever you want. And then it would just look something like this, just so I understand what it can generally look like. Now, for what I usually like to do is actually assign some colors to it as well. So for example, the lows can actually be in red. Let's just leave it as that. And then obviously this one down here as well. So that's generally what I'm going to be doing on the charts over here. Now, in terms of the next step, what we're going to be waiting for is a change of character with a body closure. This is something that not a lot of people even understand. You know, you try to learn smart money concepts, and still even then, you're not applying this knowledge. When it comes to the change of character, one very important tip that I always advise to any of my students is this. You always try to look for a body closure below. Sometimes what you can get is this. As price moves towards the bottom, as you can see, a change of character is going to be considered once we get a break below this low over here. So it would look something like this. This over here would be considered as the change of character. And then obviously from that point onwards, we'd look for our actual trade. Now with this over here, what I mean by body closure is I simply want to look for something like this, where price actually breaks through the low that we've identified over here. As soon as it breaks the low, that's when we can understand, okay, we now have a full-on change of character. Another variation to this is we might get something like this, where the body hasn't fully closed below, it's simply just a wick. Now, there's two possibilities when this happens. The first one is that this is simply just a liquidity sweep. And the second one is that it's a weaker change of character. So this is basically how you identify what's a stronger one and what's a weaker one. Generally, I always try to stick to the idea that yes, there has to be a body closure above or below a low or high. It really doesn't matter, to be honest, because obviously we're going to be looking at the trend. But if we do get any sort of long wick that appears there and it fully closes back inside the range over here, as you can see, what that is kind of telling me is either we've simply just swept liquidity or it's considered a weak change of character. Now with this, I would have to have a lot of confirmations on the side as well for me to enter. But in general, I would try to avoid these. So now we've understood the basic concept of step 1, 2, and 3. Now the next part is once we get that change of character with a body closure, we're going to be looking for an order block with an imbalance. Now with this one, generally what we're going to be looking for is, for example, the order block at the top. And hopefully at that point onwards, so let me just draw out a few candles over here. So let's say, for example, like that. And then this one over here is a long imbalance. Here, for example, we might get some price action, which is a bit slower. You know, it moves something like this, right? This is considered efficient price action, where as price goes upwards, it does something like this. You see? However, if you've got inefficient price action, what you would usually get is something like that, right? So when we are looking for our order block, the best types of order blocks to actually enter from are going to be from over here when we've got this massive imbalance that appears afterwards. So this imbalance, I would always mark it up, as you can see over here. And then that simply just proves to me that price is inefficient and price should eventually push back into this kind of area, at least into the midway of the imbalance, at least up till the midpoint. But generally, if it is considered a better area, it's going to go a lot further, potentially even touch the order block. Now, the one thing that you're going to learn about the strategy is we don't always enter on the order block, and I'll explain why a bit further on. But generally, that's what we're going to be looking for. So moving back to our little diagram over here, once we get that body closure down below, as you can see, something like this, we expect for price to pull back up to these kind of areas. We would look for our point of interest over here and then obviously continue to the downside. That is pretty much what the trade is going to look like. Now, many people try this on the lower time frames. The reason why many people fail at this simple change of character model is simply because it happens so many times in the markets, and on the lower time frames you have to be a lot more careful. You have to have your confirmations in line, because generally, even when it comes to my elite strategy as well, you know, we're going to be talking about it many times, just simply going through it. I have a consistent 1 to 3 to 1 to 6 risk to reward on every single trade, and 3 strict entry models and 1 golden confirmation. So the one way I always do it with my strategy is going to have 3 entry types. I link that to 1 golden confirmations. If I see everything is in line, one of them is ticked off, the other one is ticked off, that's when I enter my trade. So with that, I'm obviously able to have such a systematic approach to the market. And by the way, this is separate to the 4-hour strategy. This is my intraday strategy that I use every single day. You know, just last week alone, these were the types of trades that we were, but I was pretty much sending out live as well to the premium group. We'll talk about this later on, but you know, if you are interested, my whole strategy, I've put it down from $200 all the way to $49.99. So everything over there is pretty much, you know, included. But we'll talk about that more in detail later on. For now, let's stick to this 4-hour strategy, because that's, at the end of the day, that's what you came for. So we look for an order block with an imbalance below in this case. And once that happens, we actually set our Fibonacci tool. So with this one, forgot to include it. Set our Fibonacci tool at the variations below. So when I'm talking about these variations, I'm pretty much going to be talking about these ones over here. So generally what we're going to get is, this is something I'm going to teach to you right now as well, how to actually set your Fibonacci tools. So what you'd want to do is go to the top left corner, pick out the Fib retracement tool. You know, there are other Fibonacci tools that you can use. I personally just use the Fib retracement tool. And you're going to bring it up. At first, it's going to look very different. When you double click on the Fibonacci, it's going to come up with many colors, many numbers and everything. Tick every single one of them off. So make it a blank screen, exactly like this as well. What I want you to do is to pretty much, let me just get the actual one that I use, template. And then we have got the 62% fib. Let me just see. Yeah, okay, cool. So with this one, in general, what we're going to be using is something like this. And I'll also be including this in the PDF at some point. So we're either going to be using the 72% fib retracement tool, or we are going to be using the 61.8 fib retracement tool. Now, let me tell you the difference between both of them. The difference that you want to be looking for is this. If we are using the 72%, and let me just mark it out exactly the same over here. If we are using the 61.8% versus the 72%, our risk to reward is going to change quite a lot. So in general, what we're going to be looking for is when price sort of retraces downwards. So let's say something like that. Over here, that's the low. We expect for price to basically come back and then eventually from one of these kind of areas, push downwards. The reason we use these areas in general is if you look up the history of Fibonacci, the 61.8%, I believe this is known as the golden ratio. Don't sort of put me on that. You know, I'm not too sure. But when I was looking into this in the beginning of my journey, 61.8% is a figure that we see in life forms throughout life in a way. And, you know, when this Fibonacci retracement came out as well, we use the same kind of concepts. Either way, forget about the concepts at the moment. We're simply talking about the risk reward over here. When you use the 72%, you would put your entry over here. Entry at the 72% fib retracement. Stop loss just above the high over here. You could even extend it further, but because we are trading on the 4 hour, generally, if we are breaking above these kind of areas, I wouldn't really expect the trade to hold up anymore. So anywhere around that kind of area, and then our take profit is going to be at the low. Now, there is a different variation in terms of taking profits. I might actually include this as well. So this one is all about taking profits, right? TPs. I'm also going to be including one when it comes to actually, so this one's for entry, my bad. And then when we're talking about take profits as well, that's going to be a different issue. So for now, the 72%, and then we've also got the 61.8%. So again, similar type of thing. We're going to be putting stop loss just above there. Now, the one thing I want you to realize is this. You're going to have two variations. If we are entering from the 61.8%, you're going to be getting a 2.6 risk to reward every single time, as you can see over here. If we are entering from the 61.8%, it's a smaller risk to reward of only 1.6. So in general, that's what you're going to be mainly aiming for. Again, it is going to be up to you what you decide to use. For me personally, when I am using this strategy, it is mainly going to be from the 72%, just because that risk to reward is a lot nicer than the 1.6. And occasionally, you know, when you are backtesting this, and by the way, please do look at a backtesting sort of tool or whatever, and just use this. You know, I've got an affiliate down below for Trader Edge, one of the best backtesting features that I personally use as well. But you are going to see the difference when you use the 72% and the 61.8%. I would generally advise to use the 72% over here, simply because the risk to reward plays out much better in the future. Yes, you might incur times where you actually miss the trade, but in general, that 2.6 versus the 1.6 is going to be a big game changer in the long term as well. When I'm talking about the variations of the take profit, this one's going to be something that I'd like to talk about as well. Generally, with this strategy, what you're going to be doing, and I'm going to be showing it many, many times over here, you are going to be entering on, say, for example, the 72%. And once you actually do enter over here, so as you can see over here, entry over there, right there, you are going to be basically getting a 2.6 risk to reward at the 0% area. So once price actually reaches the end of the range, you're going to be getting 2.6. Now, if you want to extend this and you have reasons for it, so let's just say, for example, you're aiming for these highs over here. This will obviously extend, and you would base it on market structure. Now, that's something that's not that's variable. It's not mechanical. With this strategy, I've tried to bring as much of a mechanical approach as possible. Hence why this is pretty much like a set and forget type of strategy. You put it in, you put your entries, your limits and everything, and then you don't touch it ever again. Again, if you are monitoring your trade and you do want to have a longer take profit, that is obviously one of the variations that you can do. So when we're talking about the variations over here, take profit 1 is always going to be at the end of the range. Take profit 2, if you'd like to do it, is going to be at any variable point in market structure. So this one is optional. Obviously, that's only if you want to extend your take profit and then obviously get into that. Again, guys, please just note, if you do want this PDF guide, I am going to be sending out for completely free in the link below. And obviously, you'll have access to this as well as the SMC course that comes with it as well. So whole 7 modules, no questions asked, completely free. So just getting back to it over here, as you can see, this is the type of thing that you can do. So obviously, you can extend further. Just remember, you would have to, so let's just say we have got equal lows over here, and that's what the model looks like or something. That would be something that you would actually, it would be an appropriate type of thing to do. If, for example, you are aiming for thin air and there's literally no market structure, there's nothing on the left-hand side that you can actually look back to, then I would not do this. Because again, at that point, you don't really know where price is going to go. The least you know that it's going to go to is to fill the end of the range of the Fibonacci that we've been using. So by now, this is pretty much, it should all be making sense. These are the simple 6 steps that you are going to be using. You are going to enter your limit. Stop loss is going to be at the 1% mark over here, just above the high. Take profit is mainly going to be at the 0%. Again, there are going to be variations of the entry, the take profit. And when we're talking about risk management as well, one thing I would generally advise for this type of entry is, because imagine this, right? You're working on the 4-hour chart. So you aren't going to be getting as many entries as you are going to be doing on the lower time frames. One reason why my elite strategy works so well is because this is something that's repeatable every single day. A 1 to 3 is a minimum of what I look for, and hence why it makes it so mechanical. Again, when I am sticking to my entry types 1, 2, and 3, I link it to my golden confirmation, and then I'm able to enter the trades. And that's exactly how I'm able to get into these and obviously send it out live as well. All these types of things, I have the evidence for it, and I have all the trade entries. If you go on my Instagram, every single time I enter a live trade, you'll see the entry, you'll see the actual profit that I'm in as well. We're not working on demos here, we're not working on anything. You'll see all my live accounts, it's all there on Instagram. But yeah, back to it. We want to keep it as mechanical as possible. So I would generally advise, stick to that 2.6 risk to reward, and you'll be quite good with this entry, with this sort of 4-hour strategy. Now, what I want to do is I want to get into some of the charts. With the 4-hour, of course, we are going to be getting some entries. It's not going to be, for example, as many as the 5-minute chart. But yeah, let's get straight into it right now. And so just a quick little side note for those of you that really want to take their trading to the next level. The one thing I always recommend to my students is backtesting and journaling. And the one place I personally use for all of this is Trader Edge. So this software gives you all the access to every single backtesting feature that you need, a whole strategy tester to allow you to put it into different libraries, a calendar, which I believe is actually one of the most essential tools to accurately track your trades and see your progress over time, and one of my personal favorites, the forward testing feature, which allows you to project how a certain strategy will do over time. So if you want to get started with this, click the link in the description to access one of the most trusted backtesting softwares there is available. When we are looking at AUD, NZD, in general, for this type of approach, for this strategy, you can use any pair. Again, when you are looking at your watch list, for example, what I would generally advise is obviously, if you do have the time and you can sort of look at your complete watch list on a Sunday, that's something that I would advise. Just go through the pairs, have a little look on the 4-hour chart. Again, it's not going to be much work, just scanning through it as well. For example, you're just going to be looking on the 4-hour chart, zooming out, as you can see over here. And then at that point, that's when you'd basically just mark out your highs and lows, look at the change of character that's created as well, and then look for order block with an imbalance, set our Fibonacci tool at the variations below. I would advise for the 72%, and then you enter your limits. And simply, it's as simple as that. Now, going back to what we were looking at, just bringing up the little green list that I've got over here. In general, This strategy appears, I would say, either maybe once or twice a week. So in general, over the month, you could potentially get between 6 to 8 entries or 6 to 10 entries. That's what I would generally advise on one pair that's working well. Obviously, backtest it on a few that you do like. Just skim through any of the charts. TradingView is for completely free. If you do want to use the backtesting tool down below, obviously you can use that to your advantage, but honestly, you don't even need to. It's something that's extra. It really does help your trading. But even if, for example, you can't afford it and you simply just want to use the strategy, go on TradingView and just look back on the 4-hour chart. Now, just going through some of these examples right here, what do I talk about? So let's go through them one by one of what I've got. Now, in general, as you can see, the trend was moving to the downside over here. We've marked out our highs and lows. As you can see, boom, this is a high, this is the low. And then now what we've actually created from this point onwards. So that would be considered one of the highs. Again, with this one, it's a bit of a slight variation because for me personally, not many people would consider this as a high, but because of the way market was moving at that point, I would consider this as a nice body closure above this kind of area. Again, it would have been nicer if it did close above here, which it eventually did, and you could have gotten into the trade. But we're going to be talking about this example over here. Again, if you are going to be entering on the 72% fib retracement, that's generally what I would recommend. When looking at this one over here, this possibly wouldn't been one of the most optimal types of trades because again, when we are looking at this, we haven't really got the cleanest imbalance above. Yes, we have the order block, but the imbalance above is quite efficient. So this one would have been more of a risky approach to definitely take compared to some of the others, for example. But yeah, as you can see, very, very clean, and then move into that 1 to 2.6 risk to reward. So this is something that generally you're going to be looking for. Again, moving on to some further examples over here. As you can see, price fully breaks down, has a change of character down below over here. So let's just quickly mark that out. And then let me just put that little template, change of character over here. It fully breaks down, candle closure below. As you can see, we would mark out where the low is printed. So as soon as we start to get price moving upwards, breaks above this kind of low over here, as you can see, that's when we would consider the low, Fibonacci at the top, basically plot it out. And then as you can see, price hits it very, very cleanly at the 72%. Now, if I was in this trade over here, AD and ZD, what I would have been looking for is take profit 1 at this low. Now, because market structure has been respecting it very, very nicely, as you can see, just printing this out over here, where can we expect for price to continue downwards? This is the most simple type of market structure to trade that you can take. Simply take profit 1 would be there, and then we would also consider our price in the history, right? We'd look where can we actually see that price has gone down to, and again, you could have extended easily over here, and that would have been a 1.387. 1 to 3.87 risk to reward on this right here. So guys, I really do hope that this is making sense. The 4-hour strategy is as simple as you can get, really. This is something that generally, because I do stick to my elite strategy, as I've told you, it yields me very, very good returns on a monthly basis. And I'm not having to do this every single time, but if I was having a full-time job, and again, guys, I don't know if you know much about my history or whatever. If you do follow me on Instagram, you might know more about me. But there was a time where I was at university as well. I understood, exactly how busy you would be. With university, it's a bit easier, or with your studies, because again, you can use your phone anytime. When it comes to a full-time job, I was working as an architect as soon as I graduated. At the time as well, even as a student, I was working at a restaurant job, cleaning and everything. And it comes to the point where you can't be on the charts every single time. Otherwise, you would just be getting in trouble and stuff, and you don't want to risk the job. Well, that's the mentality I had at the time until I got into trading. So if I was in that type of situation, I would definitely stick to this type of thing. Again, it really is a set and forget type of entry model. It's as simple as you can get, really. Now, looking at this other example as well, I just want to prove again, as we move backwards, price is moving downwards. As you can see, we would mark out some of the highs over here. So this would be considered a nice little high. Price had a little change of character above. So again, we're going to be marking out the change of character over here. As you can see, price comes downwards. And again, in this example, 72%. In this example, as you can see, the stop loss was here. Generally with this, I'm not going to say it's 100% win rate because with the strategy, again, you are going to incur losses at times. Fundamentals does play a big part in it. So one thing I would advise is learn fundamentals. This is something that I do offer within my premium group. Not only do you get the strategy, but people do really learn fundamentals, a whole 40 videos on everything that you need to learn when it comes to interest rates, GDP, how to review the market when massive sort of news events come out. That's the type of thing that we understand. So again, we can avoid some losers based on fundamentals, but if you are sticking to a strictly mechanical guide, this is going to be it, and you are going to incur some losses. So I wanted to include this as an example, not just to show you that you're only going to be getting winners, because at the end of the day, you are still going to incur losses. However, the one thing I will say is this part is key: risk management. Stick to 1 to 2% risk per trade. Generally, I would advise, if you are sticking to the 4-hour chart and you are doing this on, let's just say, only a few pairs, I would say 2% per trade is okay. However, if you are doing many pairs, 1% is sufficient, and I wouldn't do any more than that. Because again, this can be applied on many different types of charts. All asset classes in a way. Always remember, we are aiming for that 2.6 risk reward as our take profit one. This can be traded on multiple asset classes. So if you bring up anything, look up any chart that you can have, AUD, NZD. Barely any people trade this type of chart. It's not as liquid as Euro USD, for example. But again, the same principles still apply. Again, avoid a trade in multiple pairs with the same currency, as you may be overexposed if the trades go wrong for both. By the way, what I mean by this is very simple. So let me just scroll upwards. Let's just say, for example, you have got AUD NZD. Let's just say, for example, you have got AUD NZD, and then also at the same time, you have got AUD JPY. Now, these are going to be two little sort of nice pairs. With this one, you've got a buy. And then with this one, you've also got a buy as well. So what does that mean? Let's just say, for example, we are risking 2% per trade on each one. What we are going to be expecting is that price will either hit take profit for both of them, or, for example, it might hit stop loss for both of them. Now, if it hits take profit for both of them, what we will experience is, if we're saying a 2.6 risk to reward on that, that's going to be roughly about 5% gain if we win for both of them, in a way, because generally we can assume that in general they are going to be correlated. It's not always the case, because there might be a massive difference, but if they are roughly correlated, so say for example AD stays the same, JPY and NZD, in this case they are opposite, because this one's risk off and this one's risk on in a way. But yeah, this is just a general rule. If you win, that's what you're going to win. If you win. However, if you lose, you're going to be losing on 4% if you lose. So you are going to be losing on 4% in total. So that's one thing that I would definitely avoid if you are using this type of trade. Loss in total. So that's why if you are using two pairs that have the same base currency, I would generally use 1% risk for both of them. So that's something that I would add as well. Only use half risk. No. Let's just quickly type this so you guys can have access to it. Only use half risk on two trades if they have the same base currency, such as AUD JPY and AUD NZD. This one, I really do think it should be very simple to understand. Stick to your risk management. This is the one thing that's going to save you in the long term. So many people struggle with trading simply because they can't stick to their risk management at all. It's actually ridiculous, like how easy it is to not over leverage, to not over risk. Just be disciplined. That's my only piece of advice. Now, getting on to a few other examples as over here, for example. As price is pushing upwards, very simple. Price is pushing up like this. High, low, and then again, we've got a high over here. So in general, if price was to continue upwards, a new low should be created, respected, and then it continues upwards. But in this case, we had a change of character very nicely. So this one, again, we can identify it as a change of character. As soon as price gives us that change of character with a body closure, so this one wasn't a body closure, as you can see. This one was, because it closed directly below the change of character. As soon as that happens, we mark out the low that's generated. So you'd go something like this. So you point out the entry over here. Again, I advise for the 72%. In this scenario, you would have actually missed this trade. So if you did go, for example, for the 62%, you would have had this trade. Now, again, that's just something that you'd have to observe over time. It really is up to you. Do you want to go for that long term, not being able to miss a trade, but lower risk to reward? Or, for example, you miss the trade sometimes, but high risk to reward. Simply, it's just going to be the way your risk appetite is in a way. But again, if you did enter on the 61.8% retracement, would have been a very, very nice 1 to 1.6 risk to reward. Again, moving backwards as well, another example of a loss over here, as you can see. And then over here, a very nice example of a win from the 72%. So if you backtest this again and again and again, you are going to see how many times it does work. I would generally say this is one of the best high time frame strategies that you can use. The one addition that I would give to all of this is, if you do want to take this a step further, fundamentals is so key. The reason that on the lower time frames we don't experience as much of a difference with fundamentals, hence why I can be so mechanical, is because on the 5-minute time frame, yes, fundamentals affects news events and everything, but it doesn't affect, for example, massive moves in sort of smaller moves in the day, right? So that's the difference. If you are trading on the high time frame, you want to be really careful looking at the 4-hour chart, looking at fundamentals as well, and just getting all your confirmations in line. But yeah, guys, I really do hope that was very, very useful to you all. The 4-hour strategy is generally one of the easiest that you can follow. Again, 6 steps, a few variations, and a strict risk management plan that you can stick to. So guys, if you do want this free PDF guide down below, look in the link in the description. You obviously have access to that. And just a reference back to my elite strategy, this has been out for, I would say, over 6 to 7 months. We have over 2,000 elite traders. Honestly, I don't even know how many funded traders we have at this point. I just know it's in the hundreds because of the amount of people just constantly sending it in. And again, you are going to be receiving the elite strategy course, the whole PDF guide, and again, for the price only for $49.99. So again, if you do want to learn the elite strategy, $49.99. If you want to obviously upgrade to the premium group and get my live entries and everything, you can do that at a later date. But learning the strategy is as simple as this, 75% off. So guys, I hope you enjoyed this video, and I'll see you all in the next one.